Hello all, let's discuss accrued revenue and the adjusting entry for accrued revenue. Accrued revenues occur when services have been provided or product sales have been made that have not yet been billed for or paid by customers. So accrued revenues occur because there's a mismatch between the time of customer payment and the time that goods or services are actually delivered. Accounting for accrued revenue is based on the revenue recognition principle. GAAP requires that revenue be recorded whenever the services are provided or the product is delivered. Revenue is recorded regardless of whether or not cash is received. So pause your video at this time, read this entire section, and be prepared to go through a couple examples on accrued revenue. Our first example deals with PG Training Group. On August 31st, PG Training Group provides $25,000 in training seminars to one of its customers. On September 1st, PG Training invoices the customers for $25,000 with payment due in 30 days. Record the adjusting entry needed in August for PG Training's books. Well, first of all, let's look at the T-account solutions. During the period, there's no entry made. There's no entry made because we're not billing these guys until September 1st. But we do have an adjusting entry at the end of the accounting period. On August 31st, we have to debit accounts receivable and credit training revenue. We're debiting accounts receivable because accounts receivable is an asset. It's an asset that keeps track of what people owe us. Accounts receivable represents our right to claim funds from customers that we have provided services to. So it's an asset. Assets increase on the debit side. We debit accounts receivable for $25,000. Because we'll collect this usually within 30 days or so, accounts receivable is typically always a current asset. Now, training revenue is a revenue account. Revenues increase on the credit side, so we credit training revenue. The reason why we're recognizing the revenue is because of the revenue recognition principle that states that as long as we deliver the service, we're entitled to recognize the revenue. Now look at the second example. On June 30th, PG Training loaned $100,000 to one of its clients at 7% for 9 months. Record the adjusting entry on December 31st. All right, so what we do here at the time of the loan, we debit notes receivable and credit cash. We debit notes receivable because this is an asset and it represents money that one of our customers owes us. We don't use accounts receivable, we use notes receivable here because it's a formal document that has been signed with us. We have loaned money to one of our clients. We've required that they sign a document that says they will pay us in 9 months and 7% interest. Notes receivable is an asset, it's increasing, so we debit it. We're lending out $100,000 in cash. Cash is an asset. It's decreasing because we're paying it out, so we credit it. Now let's look at the adjusting entry on December 31st. We loaned the money to the customer at June 30th. So they've had our funds from July through December, which represents 6 months. 6 months of interest that they owe us. So what we do in the adjusting entry, we debit interest receivable. We debit interest receivable because our client owes us interest in the amount of $3,500. Receivables are assets. Assets increase on the debit side. We credit interest revenue because we've earned revenue totaling $3,500 during this period. Revenues increase on the credit side. How did we get this $3,500? Well, we multiply the principal times the rate times the time. So in this case, We've loaned our customer $100,000 at 7%. The 7%, remember, is an annual rate. They don't owe us an annual amount yet. They borrowed this money on June 30th, so they really owe us 6 months of interest. So when we do the calculation, we multiply 100,000 times 7% times 6/12 of the year. When we do that calculation, we get $3,500. So again, the adjusting entry requires that we debit $3,500 to interest receivable to keep track of what people owe us in terms of interest, and we credit interest revenue for $3,500 to record the fact that we've earned $3,500 of revenue during this period of time. Look at the observations. Failing to do this adjustment would mean that the income statement would have revenues understated. We wouldn't have recorded training revenue or interest revenue if we have failed to do this adjusting entry. Anytime revenues are understated, net income is understated. On the balance sheet, total assets will be understated. We won't record the receivables that are due to us. And stockholders' equity would be understated because if income is understated, retained earnings is understated, and retained earnings is part of stockholders' equity. All right, now pause your video. Take a look at these T accounts. Make sure this all makes sense to you. Read the narrative to the left. Thank you for watching this. I hope this helps you with accrued revenue. Have a good one. Thank you.